All right, welcome everyone. Start off here, quick reminder on our disclosures. We're not a broker-dealer. This is for educational purposes only. Everything we're talking about today will be from hypothetical simulation, not representing normal market factors that you would have to deal with in the live environment. So welcome. Today is the class on options trading edges. Throughout the years, working with newer and more experienced options traders and giving lots of webinars and classes and workshops, the number one constructive criticism that I've received over the years is always a request for more examples. So today is going to be all examples. Everything is going to be taught by using examples. So that has proven over the years to be the best way to learn, not just theory and bullet points, but using a look at actual trades in order to gain a better understanding of how these things work. So today, our objectives, we're going to review 3 option trade types. We're going to look at a mix of winning and losing trades, so that you get a nice broad spectrum of how things look when they're going well and how things look when they go bad. How things look when the market moves a lot, how things look when the market doesn't move a lot. So you get that good full spectrum from that. And then we're going to compare, in each of these, we're going to compare the underlying market to the options market. So the options market is directly related. It is a derivative of the underlying. But those options move very differently, and these spreads we can trade move very differently. So we're going to compare those. We're going to compare several things: the risk and reward, the P&L, when things work and when they don't compared to the underlying, things like that. The 3 trade types we're going to look at are a long call, a credit spread, and a butterfly. So one is to buy an option, the other is to be a net seller with a directional bias, and the third is a market neutral trade that we're looking at. So trade setup 1, right into our examples. We're looking at Apple. This is just a hypothetical scenario. If the market were to sell off and be at a gap fill level, we're just going to take this as, hey, we're going to get long here. So this is a long bias on the market. And we're going to do 2 bullish trades and a neutral trade on this. But first, just the bullish trade using that long call. So 2 trades that you can make. This is our comparison of the underlying versus the option. So we're going to compare buying the stock, so 100 shares of stock at this current price point shown to be a $15,000 position in the stock. And the second is going to be long a call. And we're using 1 call and 100 shares because a call is a contract that controls and gives you the option on 100 shares. So this gives us as close as we can, apples to apples, of exposure to the market, how much we're controlling versus how much we could buy outright. So one of the beauties of options when you buy them is your out-of-pocket cost, capital required, is significantly less. You're basically renting the right to buy the stock, and that right to buy the stock changes in value, but you do have a limited amount of time on that. Just any other kind of rent would be a short-term period of time, not an actual ownership stake. This is a picture of what a call looks like on a risk graph. The type of call we're using is a slightly in the money, is what we call it, call. So you're actually buying the right to buy the stock even at a little bit lower of a price. Very common to discuss or find if you look at other training, talking about calls that are at the money. So it says you can buy this stock at this price or higher, or you can go out of the money. So that means if we get above this certain price, you'll have the right to buy the stock at that price. But I prefer in the money. It gives you a little bit more strength in exposure to the market with just a little more cost. So that's just what we're looking at, but for the purposes here, It's the one we've selected. We could dive deeper and look into various other types as well, but this is the one we're looking at today. So this right here, where you see that inflection point of the expiration graph, that's this bluish purplish line here, that inflection point is the strike. So this is where the market currently is. This is the strike price. We currently have 0 P&L. It actually shows a -1 because of commissions estimate. So if the market rises, which is to the right, we kind of flip things horizontally for the underlying market. P&L for the option is up and down on the y-axis, and the x-axis is the underlying. So if the underlying price moves up, this can be profitable. If it moves down, this would lose money, but we have a defined amount of risk in there. So we won't get too detailed on the analysis of what the call profile looks like, but this is a quick snapshot showing you that. So this is going to be an example where things work out lovely for the bullish bias, and we're going to use a couple different trades to look at that and look at the comparison of the P&L. So the results of that, selling if breakout, close at a new high, even the day before that would be the actual close at a new high, but that's the exit point that we're selecting. The results are, if you own the stock, you would have $1,900 P&L on a $15,000 position, which is 13% return. And if on the call, you'd make slightly less. And one reason for that is you don't get that one-for-one P&L until it gets very deep in the money. Then it starts to act just like the stock. So you have that P&L difference, and you also have the cost of the option. But it's 1,500 divided by the 925 cost. So even though it's less total P&L, 1,500 versus 1,900, your cost was far less. So your actual return is 165% on the cost of the call. But that's only the cost of the rent. So it's a very low number, but you can lose all of that much easier than you can lose all of the value of the underlying equity. So as an example of risk, though, let's look at the tail risk here. What if Apple opened down the next day for a 20% sell-off? So gap down 20%, either the whole market sells off overnight or bad news comes out for Apple. But either way, let's just look at a scenario of down 20%. The stock position could lose $3,000 on a 20% gap down. The call would only lose $900. We did pay $925, but on the analysis where I looked at it, it does keep just a little bit of value. Possibly would lose even less because the volatility can actually increase the value of the call, but the estimate would be a $900 drawdown on the call. So our tail risk is a fraction, our total risk is a fraction, but the reward was only slightly less. So if we look at a return on gap risk, this is a type of stress testing that you can do. So instead of saying we're going to divide the return on the stock divided by the capital required to buy the stock, that's assuming that your risk is that Apple delists while you are holding the position and goes bankrupt and goes to zero, is completely worthless. That's a little extreme. A 20% gap risk, that might be something more of a good, solid stress test on an equity. So we use that at $3,000 denominator, saying if we gap down 20%, the return on the trade was $1,900 divided by that, so 63% return on that kind of stress test risk. The call, still $1,500 return on the $900 gap risk, still significantly better. So looking more toward just reasonable types of risk instead of just capital required, we're still showing the call looking pretty good. Example 2. This will be another bullish trade, but we're going to use gold, but using the GLD ETF. And this is going to be a breakout after a pullback type of trade. So you see on the chart here, we had a pretty bullish period, nice pullback, consolidation, and then a solid breakout. So we're just going to say this would be a bullish trade that we want to take. Just totally hypothetical. We're not really talking about the probabilities or expectancy of that setup, but we're just showing a scenario where one might want to get bullish. We're going to use these two trades to compare. So same deal, 100 shares, because the call would control that same amount of shares. So that would cost you 11,800 because it's a little bit lower underlying than the Apple trade that we looked at earlier. Long one call is quite cheap compared to that, is 435. One reason the call is cheaper is just because of right where the strike price was for that. Also, it's a lower volatility market and a lower underlying price. So a little bit cheaper call and a little bit cheaper on the shares. So this was our entry point up here. We had a little follow through, big sell off, and it winds up just kind of being a big, choppy, messy period of time where we end up barely, well, almost right back where we started, but slightly positive. Slightly positive after a big drawdown. So very different scenario. The Apple trade was, you know, we nailed it. We called the bottom, we grabbed it, and the thing just took off. This is, we were kind of right, then we were pretty wrong, and then we ended up being barely right. But it took quite a while. So that's several weeks later. The stock is up a whole $40 because you're barely profitable, barely above your entry point on that after lots of volatility. The call is down 154. So, well, that was a bullish trade. I'm having the right to buy the shares. Why is that right to buy the shares worth less? The reason is because there's less time for you to have the right. So your rent is coming due. Your cost that premium you pay, that price for the call, has a time period value to it. And if you're running out of time for the market to move in your favor significantly, you can actually lose money on the call, because it's for you to sell that call back to the market means somebody else is buying it from you, and they're going to perceive it as having less value because they have less time to be right from that point forward. So that call is actually lost value, and this is what it looks like. So even though the market slightly in your favor, the entry point was closer to this mark right here, slightly in your favor, but that time premium came down. That's that curve line. The curve line is today. The blue line is expiration line. So we're getting so close to expiration, it's starting to act just like it was a underlying position from the right to buy on forward, with very little extra value for the time. That's the difference between the blue expiration line and the red T+0 line, or today's line. The closer you get to expiration, and this one's only 2 weeks out now, the more it's just going to act like the underlying stock. And the difference between the two is the time premium. But what about this big drawdown that happened in the middle? Possibly you would get stopped out, depending on your position size and your trade plan. But either way, let's just look at how much heat that gave us on the shares versus the call. So the shares ended up profitable and the call ended up losing. Let's see how bad it was in the middle. So at the bottom of the move, the stock position was down $575. The call position was down much less at $378. Remember, that call option was just over $400. So it was the same thing, where we were getting to that point where you couldn't really lose much more, because all you can lose is the price of the call. And you still had enough time. You still were close enough to the point where you control the shares that you have some time premium and you have some value still in there. And we have this curve that's going in your favor, where as the price gets worse and worse, the call becomes less worse and less worse. It does get worse. It does lose money down to this point, but it's a diminishing negative return. And then on the upside, it's actually a increasingly positive exponential curve in your favor as you get deep into that right to buy the call. So that's just the behavior of these options. You have a lower drawdown in the middle, but it did end up losing when the stock was profitable on that one. So this is one of those examples of the losing side of options. But we still see the tail risk is very different, even though that very specific option and timing didn't work out. We're going to be looking at other ones where you can mitigate that. But right now we're just looking at that one specific type option trade. We'll get to the other two here shortly. So the shares Also, big difference in the tail risk. That drawdown was not even tail risk. It's pretty far against your starting point, but it's not tail risk. Tail risk is it really takes off to the downside. Big crash, that whole range just becomes hindsight, just a tiny little choppy area. I'm talking big crash. If in that scenario, the shares can lose thousands more because you have a just over $11,000 position. You're only down 575. You can easily lose another 1,000, 2,000, 3,000 in that position. The call was only $60 away from max loss. There was really not much left to lose. So very, very different type of tail risk. And if you trade just stocks or just underlying or just futures markets, you understand that as positions go further and further against you, you have a negative P&L. That every tick, every day that it has another move of equivalent size or even bigger, your loss continues to happen at the same rate that it happened the day before. It's very linear. With options, on the buying side of options, the worse the market gets, the less worse your experience is, the less worse your risk is, and you actually begin to only own upside because you've capped your risk and you still own for a period of time that upside. So this allows you to have more duration in your trades, but overall, you're going to have that one negative thing going against you, that if you're not more than right, it's got to move far enough to overcome the time you paid for, the time period you paid for, to really get into that value of that option. You've got to be a little bit more than right within a certain period of time, but then you can put all those other factors in your favor. But it is very directional, and you do have to have better timing. And if you do have better timing, you can have really great risk reward on those long options. Now we're going to look at a credit spread. So this allows you to be less than right. You can be a little bit less than right and start to have some pretty cool trades. So we're going to sell one put and buy another one below it. And we're going to loop back to our Apple example. Pun not intended originally, but now I've caught it. So apples to apples. So we're going to use the same setup in Apple. And instead of buying a call, we're going to use the short put spread. So using the same setup and the same trade period, we can look across and say, how did each of these trades behave over this period? This is what the option credit spread looks like. So up here, you've sold the put. You are a seller of the put. Rather than buying a call, we sell a put here. So you're now the obligation holder, and you have the obligation to buy, not the right to buy, but the obligation to buy if it drops below this price. But because that creates a lot of risk, because you have to take all the risk to the downside, we buy this other one further down so that you now have the right to sell to somebody else. And so you are taking one for one, just like owning the shares, this slope here, from the point where you are obligated to buy to the point you have the right to sell. At expiration, this slope is the exact same thing as owning stock, just from here to here. But all of this space in the middle is created from a net premium, where anything above this purple dashed line, anything above there, you can be profitable. So that's what I meant by you can be less than right and still be profitable on this trade. So if we are below your entry point but closer to expiration, you can be profitable. So you can be a little bit wrong, still profitable. So this is the shape. That's what it looks like. We have the same exit point, and this one you do have a profitable trade because you are not just above the strike you sold, you're not just not quite worse than, you're far ahead. You're very right. So being very right gives you near max profit. In this, you make $300. And as you can see, the curve is turned upside down. Before it was exponential in your favor. Now it diminishes in your favor. It's decreasing returns as you become right because you're further and further away from that obligation. You're further away from people buying. You got to think about the other side of the market. The people that are buying this, that's so much further away, it's not holding much value. Less time to be right, less time to take advantage of that option, far distance away. It diminishes the value of it. But as you get further and further, it can't just keep exponentially losing its value. because you're so far away that's very low perceived value at this point. But it is a profitable trade. You lose money on this one, you make money in this one. The net of the two is $300. So comparing, same deal on the shares, 13% that we talked about originally. But this has an 18% return on the $1,600 risk. So how do we come up with that $1,600 risk? That it's about $1,675. I just kind of round sometimes. So $1,675 is that capped off point down here where your obligation ends, your right to sell versus your obligation to buy wash each other out, and you are essentially flat from here down. So at that point, you're capped off at $1,675 risk. So your $303 return on far less risk is a much higher percent return on risk, even though the $1,900, which I don't have listed right here, I think it's on a different slide, the $1,900 return on the stock is much better dollar return. Your percent return on risk is different. And so here's that. So we're putting in here, in quotes, risk. So it's a 13% return on $15,000 risk and an 18% return on $1,675 risk. But if all we do is just say, hey, that's risk and this is risk, I'd rather have a higher return on risk, that can be very short-sighted. Not all risk denominators are the same. So very quickly, basic math, the way to get a percent is you put the return divided by the risk. So the risk is the denominator, the bottom number in the division. So $15,000 risk versus $1,675 risk is not the same. It's not equal. Okay? And to find out how different they are, we have to ask, when are these risks realized? This 100% risk, so hitting all of your 1675 drawdown, so to take a max loss on this credit spread, is 25%, just about 25% below the entry point of the market. So actually I have this a little wrong. I was wrong here because this is from our exit. So that's actually not quite the case. I have off on a different screen. Where that would be, it's actually, so from the exit point it's 25%. Off on my screen I'm looking, it is about 8% from original entry. So 25% below the exit point or only 8% below the entry point, you can have a max loss. That's very different. On the shares, you have to have a 100% decline in the value of the stock to have a 100% realization of risk. To have a 100% realization of risk in a credit spread, it only had to drop 8%. And it did it, if it did it by only, I think it was a 60 days. So you only had 60 days in this. If 60 days later you're down 8%, you have a 100% loss. That's a very different thing. That's feasible. That's something that wouldn't be talked about for decades to come. Remember when Apple was down 8% over 2 months? That would just be a moderate sell-off. That would not be considered unfathomable. So you have to realize that is a much more realizable loss in there. And there's strategies for when to take exits. What multiplier of your credit should you take for exits? What's your strategy for that? Should you use a signal, etc. By the way, right here at that point I said 60 to 100% loss. 60% loss is the red line. That is the, as of today, what the forecasted P&L would be if we were to be at that point. But you'd still have value in the spread because there's still the possibility of bouncing back to this point. So this is leaving value in because there's still time for this to be profitable on this end or a loss if you're on the other side of the trade. So there's still some value in there. But at expiration, it is there's no time left, and that's where you would have your 100% loss. It's just as easy to use 100%. This is a warning, by the way. I probably could have used a better header on this slide. So this is a warning about your leverage and risk in options trades. It's just as easy for you to use 100% of your capital to buy shares or sell a put credit spread. That's PCS, put credit spread, or buy a call. So you can buy, let's pretend for a moment you have exactly the amount of capital in your account that is required to buy the shares. So that'd be a $15,000 account. If you have a $15,000 account, you can buy $15,000 worth of shares. Now we're just going to ignore margin and leverage and all this stuff. We're just going to talk about outright purchase. You can buy $15,000 worth of the shares. I showed you the put credit spread would only take $16.75. So that means 15,000 divided by 16.75. That's almost 9. You can almost do 9 of those credit spreads, which means you can make 9 times the premium. So 9 times 303. You have a $2,700 credit. You can actually make more on the credit spread than you can by buying the stock on that big move. But the risk is very different. You should not treat them the same, because that means if Apple were to be down 8% 2 months from now, your account's gone. 100% loss, flat, you're blown out. So that is the danger of the leverage. When I look at these in these examples, I show them as 1 for 1. If I sell a put, I'm equating that to the same as buying 100 shares. That is the same exposure and the same risk. If I buy a put below that as a type of hedge, I'm just capping my risk. And I can look at that as a standalone thing where I have a similar amount of exposure because I'm controlling or obligated to buy the same amount of shares. So that's why we're using the exact size we are and not just talking about return on account. Yes, you could, for example, make $2,400 in the put credit. I said 27 because you couldn't quite get to 9. It was 8 point something. So 2,400 on the put credit spread for the same capital as 100 shares. That only makes 1,900. But like we said, 8% drop, you lose your money. All right. It's kind of a repeat there. Now here's this could be really exciting. You could make $24,000 by buying the call. Because remember, the calls were really cheap. They were only $925. So you can buy even more calls. But two things happen. You'd have a pretty big loss even though you were right on the underlying movement. And you actually can have a much closer, you can lose a lot, a huge drawdown by just being a little bit wrong at expiration. You can lose 100% of your account if the market were to only drop 3 or 4%. Because remember on that call profile, it was just slightly below is where your total risk was on that. So we're using unleveraged comparisons only. Same exposure to the market. The shares made $1,900 on $15,000. The call made $1,500 on $925. And the put credit spread made $303 on $1,675. So those are the 3 trades there. Now, I'm sorry, we're not done with all 3. We have the baseline of the shares. We've now covered 2 options trades. We do have a 3rd coming soon. But first, we're going to do the put credit spread on gold now. GLD, gold ETF, PCS, put credit spread. Same setup, same position, net credit, same ending point with a small uptick in the move. Remember, the shares only made $40. But the put credit spread made $113. Unleveraged, same exposure, same obligation to buy, but you get a bigger profit from the put credit spread. So the shares made 40. The call lost because it wasn't right enough. It lost its time premium. It wasn't right enough, so it's lost some value. But the put credit spread made more than both, with a lot less risk than the shares and just a little bit more risk than the call. Different type of trade. Now we're going to get to our 3rd options trade. So this is going to be called a butterfly. And what we're doing, we're diving deeper, faster. So we went from calls, the right to buy the stock for a certain price at expiration. And then you have the put credit spread, which gives you the obligation, but gives you a net credit. So you can be a little bit less than right, still keep the premium. but we're going to get into now what is a complex options spread with higher potential return and lower absolute risk. All right, that is compared to the put credit spread predominantly. So the call has an unlimited reward potential, but you can lose by not being more than right. This is going to allow you to not really have a directional opinion. It's going to give you less total risk than a credit spread. So the idea of I don't have to be right necessarily to be profitable, that stays with this. But taking the larger risk than you can make, that goes away because we're going to do a market neutral trade. This is a hedged spread. So built in within the spread, we are both bullish and bearish in the trade. So it's a hedged spread. We're also hedging because it's a spread itself. So we have the risk is capped off. So for every short we have a long. So we don't have just full obligation. We have another point where we cap our risk. And then we're also playing two directions at once against each other that both have positive theta in your favor. So we're going to take this same entry point. However, we don't have an entry bias for direction. This isn't because it's a gap fill or because we want to be bullish, because this is a neutral trade. No directional bias. Neutral trade. This is our entry point only for comparison to make it the same as the other trades, but we're not taking a bullish bias. We exit a new high just for the comparison purposes, but that could also be used as a type of stop loss where the range is broken and a neutral trade can be exited. This is the profile here, so you can see why it looks more complicated. So what happens is you have the put credit spread just like we had before, that you can see it right here. But rather than coming up here, or what we had before was it kind of stopped about here and went on, what happens is we also have a put debit spread built in too. So this is, we're buying the bearish trade and we're selling a bearish trade, which is a bullish trade, but we're putting the two together to make a single profile that actually doesn't want movement in either direction and has lots of time premium here in the middle. So same timed expiration on this, same entry, same exit, but we're going to see what happens here. Now because it's neutral, our best result is going to happen on less movement. And this is a trade we're going to compare that had a lot of movement in a very short period of time. So because of that, it's a loss. So it takes off to the upside, it loses $500. It's exited for either breaking out to a new high or just as a comparison to exit at the same time. This is what happened to this options trade. Now, I want you to make sure at this point you're planning to stick to the end because there's something very, very cool that we are going to do with this trade here. I think it's actually on the gold side of things, but how this has a really cool opportunity to it. So on leverage comparison, we're just using where we're not taking any additional exposure with the options. We're not leveraging up with them. We're just kind of doing one for one on those. So one call or one put credit spread or one butterfly for the 100 shares. So the call, same deal. We know these things. The shares made 1900. The call, it's 1500 less risk. Put credit spread made less on a little bit more risk. The put butterfly lost $500 and its total risk was $975. So its risk was a lot less than the put credit spread, but because it had no directional bias on a very big move, a market neutral bias on a very big move, it's a losing trade on that side. Now we're going to look at the gold butterfly. This is the setup here. We're going to use the same entry and exit. So we have a small net move. We have a lot of movement in the middle. We'll look at that in a second, but let's look at the end of it first. The end result is lots of P&L. So 287 or 56% return on risk on very little movement. So this is the beauty of a very neutral market neutral trade where no movement at the end of the trade is lots of profit. But what about that big sell-off in the middle? So yes, that's great, we made 50%, but there was a lot of movement. Was it a big drawdown like Apple had at the end of its trade or not? Well, I'm glad you asked because it was pretty cool. Even though there was a big sell-off against our position. So what does it mean to be against? It's not that we were bullish and this is a sell-off. It's that we moved away from our starting point. Neutral means We prefer less movement. We just want to hold a small amount of movement during the trade. So against could have been up too. A big move up would also be against. So this is against us because it's lots of movement. But what was the actual P&L there? On that same day, the P&L was only down 8%. So this is a very robust trade. It's one of my favorite market neutral trades, which is a butterfly, because it has you have the two trades working. You have a bullish trade and a bearish trade. So that big sell-off, you have half of your position is bearish and is benefiting from that movement. The other half is not benefiting, is taking a loss from that movement. The further it goes, the less that your bearish trade can make, because it has a defined amount of profit. And the other one can keep losing. It's defined, but it's a bigger amount of loss. So you're going to have a net loss, but it can handle a lot of movement because you're playing both sides at once. So you really can handle a lot of movement in the middle before you have to exit. So the trade results of all three options trade plus the shares here. And after we finish these, so this is not the end. After we finish these, I'm going to start showing you how to combine these. So stick around. We're going to look at that. Shares are $40. The call lost some money because remember, we didn't move enough. It didn't move fast enough, so the call started to lose its money. There was less time for it to really be profitable, so it starts to lose that value. Put credit spread made money because time went by and we collected, as we like to say as options traders, we collected that premium because less and less time for that trade to be right, but we were a seller of it, so that's a benefit for us. And the fly made, the butterfly, shortened down to fly, we call them, 287 on 5-10 risk. So very low risk, higher return. It's actually the best return, especially return on risk, 56%, but also just for dollar, a better return than all those. So imagine that shares, $11,000 tied up. You can lose thousands and thousands. If you're very wrong, have a big gap down, and that fly capped the risk of 500 and made more than that small amount of movement in the shares. So here's the summary of those before we get into the combos. All right, so here's the summary. Gold, kind of a yellowish gold, apple in kind of a green apple color. I was going to use red for apple, but it was a little kind of hard to look at. So just going to kind of leave that up, and you see a summary of everything we looked at. If you want to take a screenshot, kind of keep these in mind. But we had the highest percent return was the Apple calls, because we were renting the stock for a very low call premium cost and then a big move, so we have a huge percent return. And as far as a neutral trade, the best one there was the butterfly, the one where we collect premium. So that's that. So options versus stocks, kind of looking at a different comparison here. Gold stock trade, 0.3% was the return. The average option trade, all right, so we tried the buying call, we tried selling put spread, we tried buying a butterfly. Regardless of which one you picked, the average was 11% return on risk. Now we do know risk is easier to be realized in these, but if you have a stop loss, you have an exit plan, and you put these types of trades on, you can be a little bit less than right and still be profitable. You're talking about significant yield compared to how much has to be tied up and how right you have to be in an individual stock trade. Apple stock, you actually did get a big move. So you got a nice, decent return on that, but that doesn't happen all the time. With 12%, 12.7% return on your stock, the average options trade made 43.9%. So higher yield on that. Options benefits, you can use defined risk. Every one we looked at today was defined risk, defining a lot less risk for very similar type of exposure to that. And that's how that yield pops up. Without leverage, we're getting a higher yield on risk because we're capping our risk at a smaller level. So our overnight risk is much less. We can add income from time decay, and that happens in the two options, the two that we looked at. There are other types, excuse me, other types of options trades too, but the put credit spread and the butterfly have that time decay in our favor, so we can add income. It's a type of income trade from those. And then, this is where it gets to the fun stuff, we can combine them for improving our probabilities and improving our edge. So let's take a look at that. So we're going to go back to the gold example for this. our bias was long. So we're going to keep a bullish bias. So I'm now going to show you what could it look like for you to have a directional bias, but start to use combinations of options trades. So I've now shown you the individual pieces, calls, credit spreads, butterflies. We're going to start combining those to express your long bias. But could we combine those options trades to give us three things? Add income and create unlimited reward. So remember, the call didn't have income, but it had unlimited reward. Could we combine these trades to have income and unlimited reward? That'd be pretty cool. And defined risk. So that's going to be pretty exciting, right? We're talking about a bias that we layer in and add on top of it income, so we can be less than right and still be profitable. We can have unlimited potential reward just like we bought the stock. And we can define our risk, which is something you can't do with the stock other than the total amount of capital required. So the two we're going to combine. I'm actually going to pick the losing trade and the butterfly. So I'm going to pick the call and the butterfly. Why? Because the call gives us the unlimited reward, but it doesn't have income. The fly has awesome income because you're playing both sides, lots and lots of potential income for a very low defined risk. So the call, if I did the call and the put credit spread, you're taking two bullish biases. So you're basically like doubling up on being bullish and without a ton of possible income. So the fly is going to have that lots of income piled right on top of where we start, and the long call gives us all that upside. So let's see what that looks like. So it's getting a little crazy here, all right, but this is now overlaying two options trades. So first I'm just showing you the butterfly alone, and that's the blue curve. We looked at that before. But on the same day where we put that butterfly on, I'm going in, you can see up here encircled is the call being added. So we're adding that one long call into this right here. So our total risk is still less than $900 for unlimited potential reward. See how this now, instead of turning back down over here, it goes flat for a while, but then the call kicks in and it really takes off. And that inflection point right there is where the call continues to be profitable as far up as the trade is going to go, and the butterfly ends its risk. So where the butterfly's risk ends, there's a little tongue twister, where that risk ends, the call reward continues. So that's where it turns back up. All right. And then over here, both have risk. So we have the risk where the butterfly loses and where the call loses, you lose your call premium. And that little kind of inflection point right here is the actual strike where the call is, where it kind of quickly from here to here, for a very brief period of time, you actually kind of have like double exposure on the long side. But we still have a lot less risk on this. We have a bearish trade built in, so it's kind of offsetting some of that downside. So we have defined risk also down here. We have defined risk, unlimited reward, and then what we see is that little space, okay, where at the starting point, there's this space is built in, and that means we have time premium to our advantage. So now I've kind of gotten rid of the butterfly, and we're looking at just an end result. This is the end result of this, just stacking two trades together, butterfly and a long call here. This is the end result. So remember our, let me see if I can, it's going to be, yeah, it's too far away. I'm just going to come back to this. You should recall that the move was very small. So it went against us for a while, it came back, and it was slightly above our entry point. So here's right where that starting point is. Kind of just look, you know, I don't know, about a third to a quarter to a third of the way between these two gray lines. And then here we're barely any further into that. But we have the $113 profit, 13% yield, and still from this point it can ride this curve and go up and have unlimited potential reward. And then on the downside we have that defined risk still built in. So if we review our objectives here, we were trying to say, could we combine options trades to have add income? We got that. That means that even though we weren't totally right, a lot of premium decay happened and we added income to the trade where we added some P&L. Remember, the shares only would have made $40. You made $113 on the same move. That was because premium decay kicked in. Can we add unlimited potential reward? We got it. So we have income and unlimited potential reward. And did we define our risk? Yes, we had defined risk about $900 and so. So that's pretty cool. So how can you put options edges to work in your trading? First, you got to learn the language. We didn't talk a lot about it, but there are values that we talk about called Greeks. These are deltas. It talks about the change because of movement in the underlying. Theta talks about the rate of change in your P&L because of time going by. Vega is implied volatility, how much the options can change because people are perceiving more risk or more movement in the market. Gamma would be the rate of change. So that's how the curves are measured, how your trade becomes more and more profitable as you get further and further towards something, or less and less profitable as you move further and further into the trade. That is a gamma measurement. So you have to learn these Greeks. It's not too hard, but it does take a little time. It's a little bit different than buying stocks where it's just basically long, short, cover, sell. Very simple terms there. With Greeks, we have curves. Or I'm sorry, with options, we have curves to measure and multi-dimensional things taking place. So we use Greeks values to explain those so we can just quickly look. Commonly just 4 Greeks. You just look at them real quick and kind of understand your current position at a snapshot. You need to understand the unique risks in options. All right, so one of those we talked about briefly today was that your risk that's talked about may seem like a low number and something you can leverage up, but really that risk is easier to realize. There's also unique risks where volatility can kick in and change your expected P&L. Good and bad, but there's a unique risk there as well. And you have to define your objectives. So we're talking about how do you add these edges? You got to define your objectives and your risk tolerance. Are you trying to take less total risk for very directional trades, have tons of upside, but you're okay with a lower win rate, a little bit of volatility in your returns? Then you might be looking at becoming an option buyer trader. But you need to have very strong edge in your directional bias, because you've got to be right. You've got to be right within a certain period of time, and you got to be right enough to pay for the option. And if you get those down, you can have significant returns with very low overnight risk compared to stock holding. If you don't have a really strong directional edge, most traders I talk to that are interested in options and pursuing the options market, it's because they found they don't have a directional bias that's more than right most of the time. So they want to move more toward adding income. So maybe the directional bias is okay, but maybe it's a little less than right. Maybe their timing isn't usually correct. Maybe they have some trades that go in their favor, but kind of just end up chopping around. They weren't really in the best underlying market. If you start adding income to those trades, you start having things where when you're not right, you're happy because you have profits. You have profits that came in which were better than if you were more than right. And you're willing to give up some of that being more than right because it actually benefits you to be less than totally right. So that's a really cool thing about options. So if you start to learn your objectives and how your trading's going currently, you can move toward the types of options trades you want to do. And the very simple process, a lot of different places I talk about this. I call them different things each time depending on how much room I have and what the context is. But there's kind of 3 general stages, and that's practice, prove, and grow. So practice can be learned, practice can be developed, practice can be study, but it's practice, understand, learn, develop, and then prove. Prove happens through study and analysis, historically, live trading at a small size, documentation, peer review or mentor review, and then from there you grow. So don't start off with throwing out a few trades. If they make money, double your size. That's trying to skip to the end, which can often end sadly. You want to practice, prove, then grow. All right, so those are the kind of the phases to this. So 3 ways you can work with me directly to learn options trading edges. So I'd love to help you in this path that you're on. If you're interested in this developing edges and adding options edges and income and defined risk to your trading, 3 major 3 dominant paths to take with me. First, there's the options beginner workshop. So if you're thinking a lot of the stuff we talked about, kind of a little stretch for you to understand, you're not really understanding a lot of these things, you looked at the risk profile, didn't make 100% sense, but you get the idea, then the options beginner workshop might be best for you. You're still learning the Greeks, you're still learning how the different spreads work, how to construct them, things like that. So in the beginner workshops, it's a live weekly Q&A meeting. So it's not a course or an on-demand thing where you just are consuming the information. From whenever you join, you do have access to all prior meetings that you can go through and watch on demand, but you attend also live weekly Q&A meetings. And in those meetings, I will teach a new topic each week. So sometimes we'll come back to something, but it'll always be fresh and new and a new way of talking about it. And we also try to use current market conditions to really give those great examples. But you'll learn something each week in a live environment, and then you get to have questions in the group chat. So there's two ways to ask the questions. One is during the actual meeting itself, and secondly, there's a chat application where you can join and all other members are there and I'm in there, and you can ask questions throughout the week outside of the meeting as well. And then in this, because it's also a group, you get to meet other developing options traders and ask and answer questions and teach each other and learn from each other and see what other people are doing, and maybe see questions that other people are asking that you didn't think of, and that can help you in your learning as well. Secondly are the option strategy workshops. This goes a little deeper into the strategy. Same deal, live weekly meeting. It's intermediate to advanced strategies. So kind of that butterfly, starting there and going from there. And we really get into a lot of when to buy, when to sell, how to control risk, what types of underlyings, what's your commission ratio, where's your broker, how do you set things up, stuff like that. And we talk a lot about back testing, and we use reports and analysis, but a lot of it's exclusive. So inside the workshop, we'll test ideas for different types of trades. We go back in time, we see what it would have done for the last 2 or 3 years. We share that with each other, and we analyze those edges. And this becomes an opportunity for you to collaborate with systematic options traders who are at that higher level, who understand all the basics, and who have moved on to honing in their strategies and executing them well. And the third is option career path. So this is, you've learned, you're building edges, you've gone from practice to prove, and you're in the growing stage. And you want to build out your very specific portfolio of trades and rules and how you're going to manage things. And we can work together to document that edge. So getting past just understanding your edge, but documenting it as well. And that gives you something, it gives you something to work from, something to improve, but it also gives you something really exciting too. And that's something you can go out and get funded with. So we'll develop a plan for who should you go after to get capital. Should you go for a prop firm? Should you do family and friends? Should you start a fund? So we'll learn how to get funded the best ways for your type of trading, and then maybe even tweak your portfolio for the type of funding you want to get. So you can go after big capital with lower returns, very stable, about defined risk. We can go after more aggressive capital. Maybe you don't need as much, but you're going to be pushing the envelope a little harder with more aggressive strategies. So with the option career path, it is a daily correspondence journal. So we actually start to interact daily. We set your goals. We talk about your actual trading, your development, your documentation, your business planning, and we get very deep into that process. So 2 ways to proceed from here. If you are in the workshop phase, you want to either be in the beginner or the strategy workshops, you go to smbu.com/workshop, learn more about that, get signed up, and join me in the workshops. If you want to get into the career path mentoring, really move on to getting funded and growing your career, then send me an email directly, afaldi@smbcap.com. Reach out. I look forward to responding. Just put in the subject line, options career path or mentoring or something like that. If I don't respond, hit me again. Make sure I get that email. Make sure I get responded to you. But just go ahead and reach out directly to me. So thanks a lot for watching. I hope that you learned a lot today about options trading edges using the 3 examples of options trades on our 2 different underlyings and comparing it to the stock. If you have any questions, go ahead and send me an email, same address, and I look forward to seeing you next time in a live meeting or a workshop. All right, see ya.